Let's talk about some other movies right now. These prompted by calls from analysts. Hanes Brands, in particular, getting some attention. The stock got double downgraded from Wells Fargo. It's pretty rare to see a double downgrade. The analysts are citing concerns over the company's debt position, and you saw the effect it is having on the stock, with it trading lower by nearly 5% today. So basically underweight from an overweight. That's why we call it a double downgrade. And that the macro outlook could prove problematic for the company as well. That's what the analyst is saying. And that maybe management can't do anything about it if indeed things are going badly in the broader economy.
Sometimes analysis can be very simple. And I would say this that falls under the radar here of Hanes Brands. I went to the Hanes Brands website. They're selling a 10-pack of boxers for $29. I mean, that to me is very, very sharp pricing, and comes alongside a quarter where they just exited a couple months ago, where they exited with too much inventory in the channel. And it's not just boxer briefs and tidy whities, it's also Champion. Champion has been a big growth driver for Hanes Brands for some time. That sales for that brand has now started to fall off a cliff, also leading to more inventory issues. Not surprised by this, and I wouldn't be shocked when Hanes Brands reports very shortly here that they might warn again.
And it is challenging to push forward a company like Champion to operate more of the brick and mortar retail experiences at a time where the consumer is being, perhaps as Wells Fargo is calling it, more cynically here, reacting more cynically within where they are purchasing and where their discretionary dollars are being put to use. So that all leading to Wells Fargo to slash their estimate 30% below consensus 2023 earnings per share.
I am a little surprised that you wouldn't think that something like a Hanes Brands would get a benefit from a trade down effect. But I guess if people are making the decision to buy less overall, maybe they're the underwear replacement cycle. I don't know.
Wow.
Like the sock replacement cycle.
I'm not going to go there.
No, I mean, you know, like how often do people typically rebuy these kinds of...
You should be buying underwear on a regular basis. You can't keep using the same style stuff.
Of course, but I guess what I'm saying
Underwear.
is I wonder what that typical cycle is, and then does it get lengthened in times of economic hardship?
So you want to just continue dirty, beat-up underwear.
I need to read a white paper about this.
Brad, you better go to Paramount.
We're going to talk about Paramount because the buying bottom for socks means you're wearing more holy socks out there, guys. Also, let's talk about Paramount here. You're taking a look at shares. They're down 5% right now after Wells Fargo downgraded the media giant from equal weight to underweight, saying cord-cutting concerns have worsened. Yeah, they have. That's actually kind of showing up in some of the results that we had seen start to come through last weekend, and really on the telecom providers, those that offer internet services where they're seeing subscribers or the combination of internet services and cable subscriptions. We saw this in Comcast. If you're seeing more people actually cutting the cord, what does that also mean for some of the core companies that have relied on either their content going into or being licensed out? And Paramount is one of those major companies that would rely on a number of people keeping their cords, at least for the time being, while also mounting their own type of subscription plays in the near future too on the streaming front.
Yeah, Paramount stock had a pretty good September, and I'm not surprised. You know, I think back to CEO Bob Bakish talking to our very own Ali Canal at the All Market Summit, struck a bullish tone on their business moving forward. But Stephen K. Hall is the analyst that wrote this note over at Wells Fargo, probably one of the best media analysts in the game. In addition to what you mentioned, Brad, he also notes, we see opportunities for Paramount to unlock value, but don't think they're currently under consideration. I would imagine that would be more asset sales. Paramount has moved quickly under this new management team to sell off various assets. I believe their book publishing business they sold off a year and a half ago or so. That doesn't look to be under consideration, and Stephen doesn't like it.
Yeah, and if the company doesn't do those things that he suggests, he says the valuation should be closer to its peers like Warner Brothers Discovery or Fox.
All right, from streaming to dirt. And finally, shares of Caterpillar are in focus after UBS downgraded the stock to neutral from buy, but maintaining an upbeat outlook on the equipment maker long term. And surprise, surprise, this comes against the backdrop of more lockdowns in China, which of course is a key market for Caterpillar.
Yeah, they were saying that their thesis on positive margin inflection is playing out, and particularly some of the positive trajectory for margins and earnings growth from here is reflected within this downgrade. And so within that, they're expecting sales and margins to grow through 2024, 4% ahead of some of the consensus EPS for that year too.
Yeah, this is after the quarter they had that was a pretty good quarter.
Good.
But, you know, we'll see what ends up happening going forward now.